Hi guys, it's Thursday, June 14th, and I just want to get on here and talk about the Fed's rate decision meeting yesterday. First off, I was going to make a video on this yesterday, but unfortunately I had a doctor's appointment, so here I am today making it. And I just want to talk about the decision and what it means for investors, as I'm going to get right into it. They paused rates at 3.5 to 3.75%, which was widely expected, but they did make a pretty decent pivot here, as it was the Kevin Warsh's first meeting as the Fed chairman, and he sent a clear message to Wall Street that they're completely focused on fighting inflation, and the era of expecting rate cuts is completely over. It's out the window. This is the fourth consecutive rate pause since rate cuts seen in late 2024 and late 2025. And along with that, the Fed completely stripped out any language in its policy that hinted at future rate cuts. So, as I mentioned earlier, any chance at a rate cut probably out the window for the near future. This is mainly due to the inflation forecasts, as they're up to 3.6% by the end of 2026. And that's up from their 2.7% estimate back in March. As we've seen in May, the inflation year over year number was 4.2%. And 60% of that was due to the oil prices. The core inflation number was only at 2.9%, which really shows you that the prices hasn't really affected the rest of our goods yet. So because shipping takes so long, some of those ships are still in the water and other things that are just causing this to drag out. So it's not fully priced into our inflation yet. So we can continue to see rising inflation, most likely due to this conflict, despite the looming deal between the U.S. and Iran. So that's why the Fed is pretty dialed in on cutting back inflation here, which is good for people's pockets in general. But sometimes it's not good for the stock market, as the dot plot projectors, which are the members of the Fed chairman, as well as some of the people that are on the board of governors and the presidents. Of their 17 members, 9 members projected at least one rate hike before the end of 2026, and some voted up for up to 3. 8 members expected it to remain unchanged, and only 1 member is still forecasting a rate cut. So rate cuts gone, rate hikes probably most likely, which is unfortunate for anyone who's likely or is trying to buy a house, and unfortunate for anyone who's taking out or hoping to take out money to pay for anything really in general. If they're trying to pay for an auto loan, anything of those natures, it's really just not the time to be taking out loans. And because you're really just going to see those rates probably spike, which is unfortunate, or at least stay where they're at, which is already decently high. This led to equities falling by 10% after the announcement, because there's higher borrowing costs, less people spending money. That's what causes inflation to go down. Tech and growth stocks took a hit yesterday, but they didn't end up taking a hit today, as the anxiety was gone in the market, and a lot of people were buying the dip from yesterday, and it led to the tech to go back up, especially tech companies that had a lot of cash on their balance sheets, because they're better placed to fight this fight this rate hike, or any rate pauses, because they don't have to borrow money as much. Along with that, bonds and yields jumped significantly, as they're climbing back up to 4.5%. They're at 4.21% right now, and the U.S. dollar index surged 1%, because again, if inflation goes down from this, the U.S. dollar is now worth more. So basically here, for your portfolio, fixed income and cash is good, as short-term yields rise. High yield saving accounts are up there. CDs and short-term treasuries are all going to be highly attractive, because the interest rates are going to go up. I don't know if they're still going to outperform the stock market necessarily, but they are very low risk, which is good news, and they're going to be returning more than maybe they normally would. But unfortunately, because of the borrowing costs, like I said earlier, mortgage rates are going to stay sticky in the middle 6% range, which people looking to buy houses are really looking for that 3 to 5% range. So that 6% there isn't really good. And along with that, the credit card loans, auto loans, painfully high, looking at 10, 11%, just not fun. And the chairman, Mr. Warsh, he made it clear that the Fed is sticking to the 2% inflation target. So it's going to be big news here whether or not the oil gets priced into June's inflation reports, what the core inflation number is, as well as the year-over-year inflation number, as to whether or not we'll actually get a rate hike in the end of the year or not. So as always, be safe out there. This is not financial advice, and have a good one.